A very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coghlan, Chief Currency Market Analyst. I hope everybody's doing okay. Good to see some good faces here, nice and early in. Brian, Gavin, good to have you. Kingsley, great. Marco, Suneth, good to have you on board. Just as other folks are coming in, don't forget that as I talk about different instruments, different products, the whole idea of this is an educational workshop. You see how I'm going about trading the coming FOMC decision. It's not a signal trading service, and that's because market dynamics constantly change, obviously. So it's not a signal trading service, it's an educational one. Those of you who are regular understand how these webinars and workshops work. And of course, today, we're trading the FOMC meeting. And this is the biggest central bank event of this week. We've also got the ECB and the Bank of England meeting tomorrow. But, you know, general learning point, and I know most of you here know this, but in case you don't forget that central banks are not all equal. I was speaking to a New Statesman journalist yesterday for a piece they were doing on the UK and the Bank of England, and I was explaining that instead of thinking the central banks as all equal players like a game of Cluedo, and if you're not familiar with Cluedo and you're not from the UK, it's not like equal players like in a game of Monopoly. Like, you know, you've got the hat, you've got the thimble, you've got the ship, and they're all kind of this equal players. In the central bank world, central banks have a hierarchy, and the top of that hierarchy is the Federal Reserve. So this meeting is incredibly important, and it will set the tone for a whole series of different assets. It'll set the tone not only for US stocks, but for European stocks. It will also set the tone for Asian stocks. It will set the tone for precious metals, for the major currency pairs, as we see a dollar reaction. And the dollar's reaction has a ripple effect across pretty much the entire financial infrastructure. So all of that is by way of saying this is an incredibly important meeting. So let's just go into it and slowly build ourselves into the picture. We need to understand the key narratives here. And just zooming out, I'm gonna zoom out by using stock markets to kind of give us that big picture outlook. Because by doing it this way, we can gradually build ourselves into the perspective that the Federal Reserve has. Now, if you just take a look at US stocks, we can see, and if we take a look at the S&P 500, that the S&P 500 has fallen from peak to trough about 27% fall, okay? Now, at the moment, markets are testing that 200 exponential moving average and have tried a break of that upside trend line. Now, yesterday, we saw a move higher on that weak US CPI inflation print. Now, I was trading that and I closed all my positions, but I traded that successfully because a weak CPI print should indicate the Federal Reserve can do less. And if the Federal Reserve are hiking less aggressively, that's positive for stocks. Because remember, companies, and this is the big picture stuff, companies prefer lower interest rates as a general rule, because lower interest rates means lower debt refinancing. And if you look at the trouble that Elon Musk is starting to get in with some of the debt structures that he has with his purchase of Twitter, as interest rates rise, he's going to quickly feel the pinch. And he was warning on Twitter, I saw just in the last sort of 24, 48 hours, about, you know, the difficulty of structuring debt as interest rates are being hiked. Now, there's many people under the age of 40 in the UK who've never experienced high interest rates. And many people in the UK have a mortgage expecting interest rates to be, you know, 1.5%, 1.9%, 2%. So even this relatively modest move up to sort of 5.5%, 6.5% in the UK will be a shock to many people. So stocks have generally been tracking lower as interest rates have been increasing. Why? Their debt repayments are higher. The consumers who use the companies have less disposable income. And remember, markets are always looking into the future. They're always future pricing. So as markets look into the future, what they see is, oh, there's going to be less consumer spending around. Companies are going to less focusing on growth. And we've been seeing, haven't we, major companies, they're not hiring. They're cutting their workforce. They may be cancelling some expansion. Look at Tesla's output in China being reduced. And this general cutting back is just resulting in canny investors who saw this right from, the turn of the year, saying, well, hang on, I think we've reached a peak here. And markets have been trending lower. And you can see here, lower lows, high, lower lows, higher lows, lower lows, higher lows, a clear trending pattern. And we've got this very simple trend line here. Prices moved into it and rejecting, and now is just waiting to see what the Federal Reserve do. So we now have the big picture. And the question is, what is the Federal Reserve going to do? And first of all, we need to know what the base expectations are. In other words, what's everyone expecting? So the expectations are that the Federal Reserve is going to be hiking interest rates up to 5% in the summer of next year. So interest rates are currently at 3.875%. Markets are expecting a 50 basis point rate hike. You can see that for some weeks now, Jerome Powell has been, reminding markets that yes, we could perhaps start to consider the effects of monetary policy lag, although they did say they'd be data dependent. But now with the recent data that's come in, particularly that week's CPI print that we had yesterday, and if you just take a look here, you can see that yesterday we had the CPI. Now we've had quite a few mixed CPI reports here, so this hasn't been easy trading by any means, but this was an easy trade because you can see inflation has come in headline below 7.1%, below the low of 7.2, the minimum expectations, and the core's come in at 6% in line with lower expectations, and the month on month is below the minimum expectations at 0.1%. So very decent dip in inflation. And if you just take a look at inflation more generally, let me show you what we can see. See, the headline inflation has been trending lower, okay? And the core inflation has had the smallest advance in 15 months with the US core month-on-month CPI print and the CPI month-on-month, okay? So both of them, the smallest advance in 15 months. That will just give markets a little bit of encouragement that the Fed can be less aggressive. Now, on top of that, one of the Fed's preferred, areas of inflation, and there's a lot, you've only got to look around and you'll see lots of different people looking at different aspects to try to understand inflation. And one of the areas that the Fed prefer is the PCE print. And this print is US services minus energy and rent costs, and this has also shown a dip lower. So that has been very encouraging for the people watching the inflation metrics, thinking, aha, yes, Jerome Powell can hike by 50 basis points, and as inflation moves lower, that's encouraging. Okay, so that is the sort of the bearish case, but it's not that simple, because the Fed's target is 2%. Look, we've got the headline at 7.1%, so we're not there yet. And if you look at the Federal Reserve's last interest rate decision, right, you can see, look, the committee anticipates that ongoing increases in the target range, in other words, we're going to have to keep hiking interest rates ongoing. They said this in November's meeting, in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. So what they're trying to do is bring inflation back down to 2%, and they will be encouraged. Look, some of them, headline inflation dropping, the US services CPI taking away energy prices and primary rent, because they can skew the inflationary outlook. That's falling. Great. That is a reassuring signal for Jerome Powell. And the core month on month and the headline CPI month on month yesterday, smallest advance in 15 months. And that's why you'll see, that's why it was an obvious trade to go short the dollar, long gold, short dollar yen. And this was my targets yesterday. I was looking for a move lower down to that sort of 13460 region, and I was looking for a move higher to 1820 in gold. And both of those targets were nicely reached. But then I was not expecting any more movement in these markets because we've got the Federal Reserve meeting today. Now that was something that I was trading amongst the financial source risk event guys and girls. So that was what was going on with me yesterday. So you can see this reaction in the markets, but you can see traders didn't want to take, this is the S&P 500, traders didn't want to run with this. Now, can you see the way that price broke above 4,100 and then sold off? See, what that tells you is a reluctance to break out. That's the key level. First of all, it's a high. But crucially, we didn't break out of this big supply level here at 4,172. If that breaks higher, you'd expect some technical buying and a trip on the stop. So in other words, that could be a very nice entry. You could probably have a 50-point stop on that because of the way that's structured. And that should potentially hold. But that would only work, as it were, if we got a very dovish Fed tonight. So the big picture is, if the Fed is hawkish, we're going to see stocks continue to fall. If the Fed is dovish, then stocks can continue to rise. So let's go back now and look at expectations so we can start to put a potential trade plan together. Right. Money markets are looking for a peak of 5%. Now, what that means is what the Federal Reserve communicate is going to be very important. What do we know? We know 50 basis points is priced in. So if it's only a 25 basis point rate hike, then you expect gold to surge higher, S&P 500 to surge higher, dollar yen to surge lower. Okay? If it was only 25 basis points, because you see it's not priced in at all. If it's a 75 basis point rate hike, you'd expect stocks to drop lower sharply. You'd expect the dollar to rise, so you'd be dollar yen long, and you expect gold and silver to plummet. But then it would all be about the future path for US rates. And the major focus for today's meeting is not going to be on the rate decision. 50 basis points is what's expected. It's going to be on the future path of rates. Are money markets right? Is a 5% peak next year correct? Or do the Fed intend to go higher? Or are the Fed intending to go lower? This is their opportunity. Now, what the Fed have to be very careful of is if they give the impression that they're sort of they've paused interest rates, then stocks can rally in a way that's very unhelpful for them. And remember, we're starting to see some slowing growth signs in the US. So the last thing that the Fed will want to do from a responsible point of view is stoke bulls to buy heavily into US stocks. It's not in keeping with the broader fundamentals. So if the Fed could have an ideal world, they'd want stocks to fall lower. They'd want the dollar to probably stay where it is, and they would want to have a soft landing as far as possible. Now, you can't always get what you want. So what we need to look for are these things. First of all, the dot plot. Now, the dot plot is when the Federal Reserve project where they see interest rates going in the future. Now, we know markets are pricing in a 50 basis point, a 500 basis point peak. In other words, 5% by the summer of next year. Now, just take a look here. The expectations by some Bloomberg analysts is for like a 4.87% peak. Now, if Jerome Powell signals that he's expecting interest rates to go to 5.25%, that will be a change. Okay, can you see what we've got priced in? We've got 5% priced in. But if Jerome Powell and the dot plot signal that instead of 5%, they're looking at going at 5.25%, then here's what you can expect, and here's what I trade. So I'd look for upside in dollar yen, I'd enter at market, and I target, first of all, 138, ultimate target will be 139. This will be if the terminal rate is expected to rise to 5.25%. First target will be 138. If Jerome Powell signals a terminal rate of 5.25%, I'd expect gold to flush lower. Target would be down at that 1760 region, okay, just in that near-term support level. I'd also expect stocks to move lower. First target would be that 3950 region, and if that broke, I'll be looking at the 3800. So if the Fed are more hawkish, I'd look to sell the S&P 500, buy dollar yen, sell gold. That would be my go-to plan. Okay. If Jerome Powell is dovish, now one of the ways he can be dovish is as follows. If in the statement that's released, say, now remember, when you're looking at central banks, often the addition or subtraction of one word can send markets rallying. The current phrase is the committee anticipates that ongoing increases in the target range will be appropriate in order to retain a stance of monetary policy that's sufficiently to return inflation to 2% over time. Now, a dovish statement will be something like this. If Powell says, or the statement says, the committee anticipates there will need to be one more rate hike before pausing, or because of monetary policy lag, the committee anticipates, coming to an end of increasing the target range. But even what they could do is just remove one word. If they said the committee anticipates that increases in the target range will be appropriate, and they take out that word ongoing, then you'd expect gold to rally, stocks to rally, the dollar to fall. Okay, that's what you'd expect, because it would say, everyone would say the Fed's pausing. Okay, they're slowing down the path of interest rates. They've nearly paused. Great, stocks can start rallying again. That's what might likely happen. Now, this is where it gets difficult, and I'm sorry to have to tell you this, but this is tricky, and I'll tell you why it's tricky. Because when you have, right, let me just get this right. When you have these kinds of decisions, can you see on the list here, you've got the Fed interest rate decision, 7 o'clock UK time. You've got the economic projections, and then you've got the press conference. So you've got three things that you need to evaluate. So evaluation number one is the interest rate decision and the FOMC projections. The market will initially move on what these projections are. Then the market often will fade that initial move because the press conference will either contradict it or add clarity to it that changes the overall message. So we saw that at the last meeting. So at the last meeting, Jerome Powell said, we are expecting, we are going to be factoring monetary policy lag as we move forward. Dovish, stocks rallied, and then said something like, but we're going to have to raise interest rates higher than we previously thought, and stocks fell. So be warned, what happens at 7 may be contradicted by 7:30. Now, this isn't just, oh, what do central bankers know they're doing? Aren't they foolish? No, this is actually quite clever communication, because the central bankers know that with one word from them or one message from them, they can send markets rallying in a very unhelpful way. So often they'll time their statements and their comments to push and pull in the right direction. So you might have like a dovish statement at 7 and then a hawkish comment from Powell later. So watch out for that. So there's two ways you can do it. The way I'm going to do it is I will trade these as two separate events. So I will trade the interest rate decision and the projections, make the trade on that, look for a short-term move, then square out my positions when I hit major support resistance, and then look for the press conference. Okay, and then trade that as a separate decision. Now, trading the press conference can be hard because you have a series of statements that come out, and it can be hard to know what is significant, what isn't significant. But I've hopefully given us enough of a picture so we can see what the divergence is from the expectations. The expectations are all focus will be on the dot plot and the future path of US rates. Markets will look at when will the Fed know when to pause? Have they paused? If Powell used any comments about pausing, we've paused, then expect stocks to rally sharply higher. If Powell talks about, the projections of 5.25% or higher, then we'd expect the dollar to rally, stocks to fall, gold and silver to fall. So that's tricky, basically. And I'm going to be covering this event live, but even when I'm covering it live, I'm only covering it live till 7:15, and then you've got the press conference coming out later at 7:30, which is really should be considered a separate event. Now, one last thing to say is gold has some amazing seasonals around this time of the year. Now, one of my favorite types of trading is seasonal trading patterns. Over the last year, I've got a return of about 27% on the different instruments that I was trading, which I recorded live with a Telegram group, and that was over the course of a year. So a very steady swing trading service. And one of my favorite trades is precious metals around the turn of the year. You can see here gold tends to gain around the start of the year. Now, a lot of that is in the Lunar New Year. So some of that is going to be thrown into question regarding exactly where China are with their COVID policy. There is some growing reports that their hospital infrastructure is starting to struggle because culturally China tends to go to the hospital when they're sick. They haven't got the same culture in the UK when if you've got mild symptoms, in the UK, you can have a fairly horrible flu, but you just sort of ride it out at home. In China, the culture is slightly different. If you're ill, you go to the hospital. So that means the hospital quickly can get inundated with relatively mild symptoms. And China seems to be taking a gamble that the relatively mild Omicron symptoms should be okay. But if China has to goes down into further lockdowns, then we may not see the normal gold demand that we see for Lunar New Year. Gold also sees a bit of demand in the West for gifts around Christmas time, and purchase managers often will purchase precious metals like platinum and gold for production use and industrial use around the turn of the year. So all of this means that gold has this pattern, and of strength into year end, and also we have marked dollar weakness into the year end. So all of that supports gold from a seasonal perspective. And you can see, 86% of the time of the last 15 years, gold has gained between 20th of December and 20th of Feb. So if, and this is a big if I have a very weak dovish Fed message, I will be looking to buy gold over the medium term. Okay, and gold is an attractive spot. And if you look at gold, now I've been trying to get into gold with my seasonal trading program, and I entered long and I exited just around these highs because the outlook is too uncertain. But this for me looks fantastic value. So if we got a hawkish Fed, dips down to 1680 with stops underneath 1600, makes sense for me from a technical point of view. Okay, find that very attractive. We've broken out that potential trend line to the upside, and if we get a very dovish Fed, then any retracements back down to there would be great for buying. We may see price, if the Fed's dovish, gold will just surge higher, right? It'll break over those highs, and then you could potentially look at a retest back down to that 1800, 1810 region would be suitable for buying on a swing trading outlook. Okay, at the moment price is just flirting with these highs, right? Moved higher. Has it broken high above that level? Right, not quite. Okay, we've got that level there, And you know, price has not. Let's just have a look at this one. Has it broken above? Oh, that's very tight, isn't it? Arguably, it's just broken higher, but I wouldn't accept that as a legitimate break. I'd also want to have a look at volumes on the NYMEX as well, just to see what the volumes are like on that. Volumes would have been quite big intraday yesterday, just because that US CPI miss. But anyway, a dovish Fed would certainly give reasons to buy gold. I'm not buying gold now, right? Even though in 3 months' time I'm expecting gold to be up at these highs, I'm not buying gold now because I want to see the picture lining up. And fundamentally, it doesn't quite line up. And if we have a little bit more of an aggressive outlook from the Fed, we could easily see gold drop back down to that 1680. And I don't want to risk, because to have your stop in place, the only place I'd say you're wrong is if price moves below that 1600 region. So that's about 11%, 11.37% stop. I don't want that. I don't see the need to have that. I'd rather re-enter at smarter areas. So that's what I'm going to be. That's what I'm going to be looking for as yeah, illustration of the current dot plot. Let's have a little look at the current dot plot. Yeah, you can just usually just find a quick. You just quickly Google it. You can usually find it dead quick. Let's have a look. Let's just see this FT. I've got one. Let's see. I'll just have a quick look, see if I can find one. No. Let's see if we can find a November one. Usually you can find one fairly quickly. Of course, this will be the that's a statement. I'll just see if there's a. Often they'll have it reported. Let's see if ING are pretty good as well. They'll often have some good data. Okay. Right, I'll give it one more shot, Gavin, and then I'll. If I just. That might be it. Let's see. That's September. We've got a more up-to-date one. Let's have a look. No, it's September. We might get it there. Oh yes, this will be the right one. Yeah, this is the right one because we didn't have one in November. Got it? Sorry about this. Right, so that's the dot plot, okay? And the medium dot plot range is what everyone's looking at. So where do folks think it's going to peak? Now, most folks are expecting the peak to be 2023 and expecting about 5%. Now, if you see dots moving up to above that 5.5 region, and if the median is above, these levels, then that would mean that the Fed are expected higher interest rates. But you've also got to look at it quite carefully. Because say this bit is these dot plots are higher, but then say these ones are lower. So say it's more marked like sharply like that, then that isn't necessarily going to have the hawkish reaction. Because if you look at the expectations, you can see, look, the money markets are now expecting, yeah, the peak to be at 5%, but then a steeper fall. So you've got to look at not only the, where the terminal rate is, but how steep is that? Now, the more hawkish outlook, Gavin, would be like this. So if this is like 5.25 and the median stays higher, like 4.5, 4, 3 out into the longer run, then that'll be more hawkish. Sorry, Gavin, it took me so long to find the dot plot. It would have been helpful if I had that up. So no, Gav, I got it. If the Fed is dovish, would you enter gold at market, and where would you place your stop? Many thanks. Yeah. So if the Fed were really dovish, Gavin, I would enter at market and I'd hold it because I would expect that to keep running, right? At market. But say, and this is what I'm expecting, I am expecting a much more mixed, nuanced picture. And in which case, I wouldn't be surprised. Look, of course I can be wrong. This is just my opinion. I wouldn't be surprised if the Fed give mixed messaging and they end up sending the dollar higher. Okay, they're going to be more aggressive because they would want to err on the side of caution, and that's what I'd be. If I was the Fed, I'd want to err on the side of caution. So I'd expect gold to move lower. If gold moves down to 1680, I would be buying pretty much regardless of what the dot plot says. It's just great value, and I am expecting the Fed to peak, at some point, because I'm expecting US economic growth to take the driving seat and say, hang on, growth is slowing, you have to be less aggressive. So 1680 is a buy, whatever, for me in gold. Very dovish Fed, buying on market, and then my stop, Gavin, I use this trend line to monitor it. So my stop would be sub 1720. Emergency stop below 1720. If it's a bit of a mixed picture, but I still think it's more on the dovish side, I would potentially look at entering a retrace around that 1750 region, and then I'd probably give my stop a little bit wider under the 1700. That's the sort of thing that's what I'm personally looking for. Again, it's not trading advice, and I know, Gavin, you understand that, but for other folks as well. Yeah, folks. Good. Final words from me is, remember, if you're going to trade this event, and it's, this is like high octane trading, it really is. Remember 2 events: the interest rate decision, and then the press conference comes afterwards. And I can tell you, I can virtually guarantee it, that there will be choppy price action around this, because if I was sat with a Fed sitting, I would want to give a slightly nuanced message, slightly mixed message, in order to keep markets as calm as possible. Give something for the bulls, and then something for the bears, then maybe something for the bulls and something for the bears again. Try to keep it as balanced as possible. So the difficulty for traders, it means you can get chopped up. The good news is, go with each push. If there's something bullish in the statement, go with it, and then close out, then wait for the press conference, and then you may stop and reverse. So you may be able to go both sides. Yeah, that's great. Oh, good. I'm glad, Gavin. I'm glad I was able to find that. Apologies for taking so long. Thank you all very much. And I am away on holiday now, and I won't be back until the new year. So I won't be doing my normal Monday webinar or my normal Wednesday workshop. But don't worry, I am intending to be back for the new year, full of energy, hopefully after a nice break, and ready to tackle the markets fresh in 2023. So thank you all very much for those of you who have been attending over this last year. Thank you for the questions, and it's been a pleasure to have you here. Thanks very much, everybody. Take care, and a very, very Merry Christmas. Yes, thank you, Gavin, and to you. Have a very Merry Christmas. And you, Kingsley, Brian, hope you have a great break. And Marco, Max, Mihai, Nikita, good to have you here, Nikita. Suneth, good to have some regulars turning up week by week. Hashik, have a great break and look forward to seeing everyone in 2023. Thanks, everyone now. Goodbye. Yeah, thank you, Ignatius. Merry Christmas to you too.